Hello, and welcome to Avalara's webinar on e-invoicing and e-reporting models explained. I'm Alex Baulf, Senior Director of Global Indirect Tax at Avalara, and I'll be presenting today. So in terms of today's agenda, I'll be setting the scene, looking at the global e-invoicing mandate timeline, looking at the countries that have introduced e-invoicing to date, and looking ahead over the next 2 to 3 years, looking at the big mandates across the world. We're also going to set the scene looking at some key terminology and how this can be quite a complex area for e-invoicing. I'll then be looking at the different models that we typically see across the world, including the post-audit model, the clearance model involving governments physically issuing the invoice. We'll be looking at the concept of embedding continuous transaction controls, or CTCs, into these models. And we'll be looking at Peppol and the four-corner model that's associated with it. And then finally, I'll be looking at the future of e-invoicing. What models are we likely to see adopted, and what are the key trends? First of all, I just wanted to provide a bit of background about Avalara. Hopefully, you know who we are already. We've been disrupting the status quo of tax since our inception in 2004. We currently have products and solutions that cover indirect tax across 193 different countries, and we're trusted by over 30,000 companies globally. Avalara provides technology solutions across the entire VAT and global indirect tax lifecycle. So this is everything from the registrations, VAT, GST, sales tax, classifying your products for VAT and customs duty, VAT determination and calculation, getting the right sales tax, VAT or GST at the point of sale, through to actually creating and sending, receiving e-invoices, as well as the preparation and submission of VAT, GST and sales tax returns. I'm now going to look at the timeline. Looking back at the last 10 years, there have been a lot of countries that have introduced e-invoicing. But as you'll see, the majority of these have been outside of Europe, particularly in Latin America. Brazil was one of the first countries to introduce e-invoicing on a mandatory basis about 10 years ago. And ever since then, other countries in the region have followed. Italy was the trailblazer within Europe with its SDI e-invoicing mandate coming in 2019. But then the majority of other reporting requirements in Europe haven't necessarily focused on the mandatory issue of e-invoices, but have involved other forms of digital reporting. This year, in 2022, we've seen a raft of new regulations and requirements, including Portugal mandating the use of QR codes on invoices, but that equally applies to paper invoices as well as e-invoices. And we've seen a number of countries launch pilots or voluntary regimes for e-invoicing. So a great example of that is Poland with its KSEF e-invoicing platform. That's initially available now on a voluntary basis before it will become mandatory in 2024. Looking ahead over the next 2 to 3 years, we are going to see a wave of new e-invoicing rules and mandates. So from January next year, Serbia will mandate B2B invoicing under its e-Factura project. And the Kingdom of Saudi Arabia, KSA, will also move to phase 2 of its e-invoicing project, where e-invoicing solutions will need to connect direct to the Saudi Arabian tax authority. We're also going to see the spread of e-invoicing further across the APAC region, with China's e-Falpio mandate spreading, as well as Peppol e-invoicing in Australia, New Zealand, Japan, and Singapore. But the real game changer is 2024, when we're going to see huge European economies mandate B2B invoicing for the first time. So that's going to include France from July 2024. So from that date, over 4 million businesses will need to be in a position to receive electronic invoices. And the largest businesses in France will have to issue all of their invoices in mandated digital formats. We're going to see similar mandates in Spain, Belgium, Slovakia, and Romania that year. And then looking ahead to 2025, 26, most likely the rest of Europe will follow. And we may even see that timeline sped up through reform from the European Commission. And in November this year, we will see the legislative proposals in relation to e-invoicing and digital reporting. So as well as talking about the common models that we see around the world for e-invoicing, I also wanted to use this webinar to tackle some of the complex terminology, because e-invoicing can be very technical. It has its own language, from some very generic terms that you'll see here on the screen to some very specific and tech-driven terminology. Some of these are unique to individual countries. Others relate to specific formats or other technical specifications. And hopefully at the end of today's webinar, you'll learn some of these phrases, words, and you'll feel more comfortable. So I'm now going to look at some of the common models. And to begin with, I'm going to look at the post-audit model, often known as the post-issue audit. And this is really the traditional, the legacy approach, how tax authorities currently audit businesses, how they get access to the data and documentation. But also, this is the most common business as usual process for businesses, how they physically issue and receive invoices today. So under the post-audit model, it's the supplier that sends the invoice to the customer direct. Where there's no specific mandate, this also includes paper invoices, particularly within the European Union. A paper invoice and e-invoice have parity. The tax authority only receive data and documentation when they request it. That might be in person, the traditional tax inspector coming out for a meeting, for an audit, for an inspection. And even then, the amount of data or documentation they view is normally quite small. It's normally just on a sample basis. Yes, they may follow up to request more, but this is after the fact. It could be a matter of weeks, months, and in some cases years before a tax authority actually has visibility over an individual transaction. So what does e-invoicing look like under the post-audit model? What are the key features? Well, it's very similar to paper invoicing, but the difference is tax authorities may stipulate certain controls or requirements around the e-invoice that is shared with the counterparty, with the customer. So where there's a mandate, these tend to be more formal, more rigid, but where a country allows e-invoicing on a voluntary basis, there is generally more discretion around the business controls that can be used. So how are e-invoices shared direct? Well, this is either direct peer-to-peer, so from one business to another, perhaps machine to machine, or it could be via a service provider, so a third-party provider who takes an invoice in any format, converts it to the relevant format, and then shares that either direct with the customer or via the customer's e-invoicing solution. One of the advantages of this is it allows for automated invoice processing. But of course, under this model, the government, the tax authority, doesn't see the data. It goes direct to the customer and again would only be visible and shared in the event of an audit or an inspection. So in terms of the general trend we're seeing, it's actually moving to a clearance model, otherwise known as a pre-issue clearance. This is the new and also future approach to invoice issue that tax authorities are following. And it's also changing the nature, style, and emphasis of a tax authority audit. So under this model, the supplier actually sends the invoice to the tax authority first. So the tax authority sees the invoice and the underlying transactional data before the customer does. The tax authority will clear the invoice for issue. So in effect, validate, provide approval for that invoice to then be sent to the customer. That may involve the addition of a digital signature to show that it's been approved. It may have a unique invoice number allocated by the tax authority. In terms of this clearance, the tax authority will run various checks on that invoice, various semantic and logical checks. That could be on the structure, on the format, on the syntax, the content. It could also involve checks on the customer itself. Is the VAT number that you've identified the customer as correct? So this provides the tax authority with full transactional data, all the data from every single invoice issued. So they're now in a very powerful position. They don't really need to rely now on periodic audits. They have a huge data set. They can run analytics, exception reporting, even AI on that data set to uncover any issues with the data quality, tax errors, inconsistencies, and even fraud. And trying to fight fraud is one of the big drivers of e-invoicing, and particularly this model. Tax authorities are looking to reduce the VAT gap in their respective country and maximize the collection of VAT. So one slight variation on that clearance model is where the government or tax authority becomes the actual issuer of the invoice. So, it can be said that they actually own the invoicing network. A great example of this is Italy with its STI platform. And in Italy, it's actually the STI platform run by the government that physically issues the invoice to the customer. So it's more than just providing approval and okay to send. They actually receive the data, validate it, and then the government is the party that then shares the invoice with the customer, with the counterparty. And the customer can only receive the invoice by accessing it from the government portal. I quickly wanted to explain what a digital signature is. Digital signature is a process of encoding a digital document to prevent tampering. And within it, e-invoicing is used by governments and tax authorities to ensure the authenticity of the sender, the business that's raising and issuing that tax invoice in an e-format. But it's also to ensure the integrity of the data, to evidence that it hasn't been tampered with, it hasn't changed over the entire life cycle of that invoice. It can be known as an advanced or qualified electronic signature. And individual governments can mandate or create and define their own requirements for that signature. But validation is typically performed by trusted certificate authorities, as well as third-party trusted service providers. I'm now going to talk about the Peppol network. What is Peppol? Peppol seems to be the buzzword at the moment. Everyone's talking about it. But what is it? Well, Peppol stands for the Pan-European Public Procurement Online. And it's not called that by accident. It's called that because it was actually set up to create a common standard for public procurement across the EU, so B2G, business to government. And Peppol is both a delivery network, how an invoice is issued and shared and received by different parties, but it also encompasses a set of standard specifications for e-invoicing to ensure interoperability between different parties, different systems, and within Europe, different countries. The Peppol standards actually meet the main European e-invoicing standard, which is EN 16931, and you connect to the Peppol network via access points, typically run by certified Peppol providers. Peppol is managed by the Open Peppol Association, and the Peppol standard is acceptable across the EU for public procurement, so the 27 EU member states. But we've also seen Peppol start to expand outside of Europe, across Asia Pacific, and there are now Peppol associations and Peppol networks to share e-invoices, not just for B2G, but also B2B on a voluntary basis at the moment in Australia, New Zealand, Singapore, and shortly Japan. The latest common standards for Peppol, on which the main requirements are built, is called Peppol Biz 3 or Peppol Biz Billing 3.0. And this is the compliant implementation of the European e-invoicing standard. And this Peppol model is built on the idea of having four corners. So what do we mean by four corners? Well, under the four-corner model, and Peppol's a great example of that, there are four corners underpinning the issue, the exchange, and the receipt of e-invoices. So C1 is the sender of the invoice. It sends the invoice to C2, which is the service provider that it has. That service provider will convert the document into the relevant format and then send that to the service provider of your customer. In turn, that service provider will then send the invoice direct to the main receiver of the invoice, again, your customer. There is choice in terms of which provider C1 or C4 pick, it's ultimately a commercial decision. Service providers convert that data to standard specifications, and each sender and receiver only need to have one service provider. They have complete free choice, and actually you're not locked in to a contract. You can change providers in the future. You don't have to select one and be stuck with that same provider for life. There are no fees charged between service providers, but service providers tend to charge on a per document basis to their own customers, their clients who use the service. Under this model, you typically require a dynamic discovery of your customer. So, for example, an online directory to identify who's on the network and how you send that invoice to them. I'm going to briefly talk about continuous transaction control, or CTCs. So this is quite a generic term used to describe a number of different digital control mechanisms which are increasingly being used by tax authorities across the globe to monitor the management of indirect tax, looking to control, compare, triangulate data received through e-invoicing, clearance models, as well as other forms of digital reporting. CTCs are often embedded within a four-corner model, but it does this by bolting on two additional corners. So one corner being the tax authority, and another being whatever portal or system that it's using to receive that data. It's even been suggested that the European Commission is looking at the CTC model as one of the most favored models to recommend to tax authorities across the EU to implement. And it appears that a number of EU member states and tax authorities are looking at this. Could we very soon see European member states scale their own Peppol e-invoicing systems that they currently use for B2G, but scale that for B2B across the entire country? Another buzzword or acronym that is often used for e-invoicing is ESPA. So ESPA is the European E-invoice Service Provider Association. This was actually an initiative set up by the private sector, creating a pan-European trade association for the e-invoice service providers. So this is generally run and made up of e-invoicing software providers, but also includes diverse stakeholders, including network, business outsourcing, financial technology, and EDI service companies. Avalara is a member, and ESPA is working to improve interoperability, looking to promote best practice, and helping align all the service providers together. And actually, we've recently seen ESPA announce that they're going to move forward with an alliance with Open Peppol. So starting to work closer together on the same leadership positions, helping to promote interoperability across the entire of Europe. So I've talked about different models, and within e-invoicing, we also have different formats. Some of those formats are very much designed for machine-to-machine, XML language that can be sent to another system, to a technology platform, and can be read by a machine and posted automatically. But I think it's quite important to look at the legibility requirements within e-invoicing, because ultimately tax authorities, as well as the business themselves, the customer, the AP function, auditors, other key stakeholders will need to be able to read an invoice, understand it, approve it. So I wanted to quickly talk about something called FactorX. So this is one of the acceptable formats in France from 2024. It is a hybrid PDF that is actually a normal human readable PDF, but with embedded XML. This is also identical to the German standard, and this is a collaboration between the Germans and the French. And I think, a great example of where we may see e-invoicing move in the future, this hybrid model looking at something that can be read and interpreted equally by a machine and a human. And it's probably as close to business as usual as you can get. I wanted to quickly provide an overview of Avalara's e-invoicing solution. So this is a scalable single solution that's been designed to meet e-invoicing requirements in over 60 jurisdictions. This involves invoice data conversion, converting to and from various different e-invoicing formats as mandated across the world, including Peppol that we've mentioned and FactorX, as well as other traditional formats such as XML and PDF. This can also involve requiring encryption of invoice data, as well as the addition of any mandated digital signatures. The solution will transmit the invoice data to the relevant party. So depending on the model, that could be direct to your trading partner, to your customer, or it could be direct to a mandated platform, to a government entity, where that will then come back to Avalara and sent on to the customer. Or in some instances, like we mentioned, Italy, the government will then send the invoice direct to your customer. And this has been designed for a seamless integration. So connecting direct to your web platform, your ERP, or other billing platforms. And on the screen now, you'll see a very high-level overview of how we integrate, how the Avalara e-invoicing cloud connects to different tax authorities and meets relevant required formats, mandates, specifications, and standards. So regardless of the e-invoicing model that the government has mandated, or whether the country itself just allows e-invoicing on a voluntary basis, subject to local rules and requirements, Avalara has you covered. We can meet those requirements. So finally, I just wanted to discuss, is there going to be the potential to harmonize e-invoicing models across the world? And what are we seeing? What are the key trends? Well, I see future Peppol expansion. I've already discussed about other countries across APAC already jumping on the Peppol train. Australia, New Zealand, Singapore, Japan. We'll most likely see more countries across Europe outside of the EU, but also across APAC, start to introduce Peppol. We may see some change from the European Commission. So the VAT in the Digital Age report has recently been released, and there'll be legislative proposals coming out in mid-November. This may actually remove some of the barriers for European countries introducing e-invoicing, so potentially replacing the need to obtain a derogation and replace that with a simple notification. We may see the European Commission also really push and promote the EU's own e-invoicing standard. And while this most likely won't stop individual countries introducing their own e-invoicing systems and platforms and rules, for example, France, Spain, Poland, Romania, Slovakia, Belgium, will continue to move ahead at the same speed and scale. It may be that the European Commission recommends that individual countries simply allow the European standard to be used. I think we'll also see the increased use of QR codes. So Switzerland has recently mandated the use of QR codes for payment data. Portugal has mandated the use of QR codes on all invoices. And Saudi Arabia is doing the same. And if you look at the draft requirements for Spain's new e-invoicing rules in 2024, it looks like Spain will also adopt the QR code. And I think ultimately, every single tax authority will want to be involved in every transaction in the world. So we will see mandatory e-invoicing spread. It's not a question of if a country will introduce e-invoicing, but really when. And it's most likely that this will be a pre-clearance model. That is the trend, and I think we'll see more and more countries adopt that in the next 3 to 4 years. Will we see harmonization? Well, Peppol's latest standard, the PINT, which is the Peppol International Document Model, should provide the opportunity for greater global interoperability. And it's almost the 80-20 rule. So we may have 80% complete harmonization, and then providing a bit of discretion for countries, either on an individual or on a regional basis, or even for specific industries, start to add some additional data fields that may be required. And another trend, as well as e-invoicing, I think we're going to see the continued spread of e-reporting. So e-reporting is where there isn't necessarily a mandate to issue a document electronically to the customer. This might be B2C transactions, it may be cross-border invoicing, but instead the data from that invoice or receipt is reported to the tax authority, normally using the same e-invoicing platform. But it ultimately means the tax authority have that data, so they have the same visibility and they can run after the fact audits on that data. So that is the end of the formal presentation. I hope you found this useful. I now wanted to see if we've got time to answer a couple of questions. I know they've been coming in, so thank you for that. One question here: what model has the UK adopted in relation to invoicing? What is making tax digital? Well, the UK hasn't mandated e-invoicing, and making tax digital is merely the way the VAT return is submitted to HMRC, the tax authority. So very much the poster boy of the typical post-audit model. The only exception to that is, if you provide goods or services to the NHS, the National Health Service, the NHS has actually mandated the use of Peppol e-invoicing. So that's been mandated over the last 18 months. So, if you do have the NHS as a customer, do double check the requirement. Are you able to connect to the Peppol network and issue compliance invoices to the NHS? Another question that's just come in. You talk about Peppol and the need to connect via a certified Peppol provider. Is Avalara certified? Well, short answer, yes. We are a certified Peppol provider in Europe and also in Australia. And I think we might have time for one more question. I got it again. It's actually Australia. You mentioned Australia has joined Peppol. Does the Australian Tax Office receive the invoice data and apply CTCs? So actually, a very good question. In Australia, the Peppol authority is the tax authority, the ATO, but they don't receive or validate or approve any of the data, within that invoice that's been issued via the Peppol network. They merely verify the standard, the format under Peppol. They don't look at the tax, they don't verify the tax, they don't collect the tax. That may change. We know what the direction of travel is. And, as I said before, my prediction is it is a matter of when, not if, countries will mandate e-invoicing and start embedding clearance and continuous transaction controls. So thank you very much for listening. I hope you found this useful and insightful. Please do feel free to reach out to me direct. My email address is on the screen now. Please follow me on LinkedIn. You can read our blogs, download our ebooks or webinars on demand at avalara.com. And we hope to see you in the future on other Avalara webinars. Thank you very much and have a great day.